want to start with you and really kind of set the landscape for investors in general right now, because frankly, equities in the economy overall have held up quite nicely, better than many had expected. So, what does that mean for municipal bonds right now? How do they fit in, and for whom do they actually make sense?
Well, municipal bonds are a primary vehicle for income for private clients around the United States. In fact, it's the very foundation of portfolio allocation for individual retail clients who are basically eager to shelter their income from both federal and, in some cases, state taxation. So I think when you look at the U.S. market, the municipal market is pegged to some degree off of the activity in the Treasury market. And what we're seeing right now is that the U.S. Federal Reserve, the Federal Open Market Committee, are coming close to the point where they're going to hit a plateau, and additional tightening of monetary policy will probably begin to level off. I don't expect a pivot. We have to remember that a pause in monetary policy doesn't represent a pivot, but we are getting close. It might be this month in June. It could be in July. This summer, we may see another rate hike. But after that, we're probably at a point where the Fed is going to basically keep its foot on the brake, but not necessarily ease until the beginning of next year. In that context, what we've seen is that municipal bonds have already increased in terms of yield. It's become far more attractive, particularly on a taxable equivalent basis. And we're seeing more and more retail clients, private clients coming to us and suggesting that this is something they want to add to in terms of their portfolio.
So, Suzanne, when you look at the landscape that Tom has set out here, how do you think investors should be looking really at the balance of the year in terms of the market and the economy when it comes to risk and credit here in Munis?
Well, Munis remain a very safe credit sector. Most credits came into the COVID period in a very strong financial position. And then there was a lot of federal aid that was distributed. Now, some of that federal aid may be masking some underlying issues. So, for example, municipalities that use that extraordinary funding for actual normal operating expenses instead of one-time expenses. Now that the federal money has dried up, those municipalities are going to have some budget gaps to fill. But generally speaking, the credit market is strong, and I expect it to remain strong for the rest of the year.
So, Tom, you touched on the fact that yields are strong, and on top of that, that most municipal bonds they're tax exempt. So investors have to look at those returns on an after-tax basis when you're going to compare them to other investments, right? Corporate bonds or fixed income.
Yes.
So when you take that lens to it, how do munis stack up right now?
Well, municipals are particularly attractive at the part of the curve which is a little bit longer than what we're seeing. What we've recommended over the course of the last 2 to 3 months, actually, is a cross-asset barbell for the fixed income part of individual portfolios. That is short-term treasuries, but for the longer duration assets, it's municipals. And that goes right to the heart of your question, which is the taxable equivalent yields that are on offer. Within the municipal yield curve, we think the years 12 through 20 are probably the best place to be if you're basically implementing that kind of a cross-asset barbell, where you're taking advantage of the very high rates that we're seeing from particularly inside 6 months, but even inside 2 years on the fixed income side for treasuries. And then when you go further out, municipals basically are particularly attractive. Again, once you get past 10 years, we'll call it 12 years, from 12 to 20. And that's been true for basically over the course of the last couple of weeks. I think that's probably going to persist.
Suzanne, I want to give you a chance to talk a little bit more about where we are in terms of being past COVID, because I think it's actually really interesting. I think many investors think that that's fully in the rear view. So can you talk to us a little bit about what we should be expecting in particular in certain areas, because there is a little bit of a domino effect still to be thinking about, right?
Yes, absolutely. Most sectors recovered very strongly in COVID. The two primary revenue sources for most municipal entities are property taxes and sales taxes, and property values really held almost universally across the country, and retail sales were strong. And so as a result, those primary revenue sources really didn't get impacted terribly. In addition, Most states were in a good financial position coming into the COVID time. And as a result, they didn't cut local aid. And that's very different than what's happened in prior recessions. But we do still have some sectors that are lagging. And I think, initially, sectors like airports, hotels, hotel tax related transactions, and convention center deals all got impacted immediately and very significantly. Those have really all recovered. Employments are really almost back to pre-COVID, if not exceeding pre-COVID in certain markets. So that whole segment has recovered. What's still lagging is mass transit. And that is because those systems are dealing with the evolving work from home policies. They're not locked down yet. And related to the work from home policies and that changing environment is commercial real estate values. We're seeing those start to be impacted in big cities as there's a lot of vacancies. And ultimately, that will play through and impact property tax levels.
It's interesting, Jen, just to follow up on something Suzanne said. What we're finding since the first of the year is that airports and toll roads have actually outperformed the general municipal market. Going right to what Suzanne was saying, this is kind of the snapback. And the question for us is whether or not going into the summer season, is that going to continue? And that's kind of the open question. But I agree with Suzanne completely. It's actually been a sector that's kind of roared back quite a bit over the course of the last 12 months.
But Tom, given that, what are some strategies for investors, considering municipals right now? How do you think it's best to access the market? Because actually, there's a lot more ways to do it than there used to be. We've got a growing menu. We could buy directly or through a managed account, mutual funds, ETFs. So what are the trade-offs of each, and what do you?
So it's interesting. The ETF sector is actually the fastest growing sector in the municipal market in terms of the buy side. It is, however, still relatively small compared to the mutual fund industry. So I would suggest that as we look at it, the mutual fund sector of the buying base is still that part of the base that effectively dictates price. To the degree that the mutual fund flows are positive, then you basically get a boost in terms of total return. And if it goes the other way, you basically suffer a bit. So what's really interesting is that we saw for the first 6 weeks of calendar year 2023 a huge surge in issuance in municipals. And that was basically driving a very, very strong 6 to 7 weeks of the year in the first 2 years. And then since then, performance has not been that great. And in fact, there's a correlation because you actually saw in the last 12 or 13 weeks, we've actually seen an exit. People pulling money out of mutual funds, probably because they're redirecting it into treasuries, frankly. But what we're likely to see over the course of a longer period of time, over the course of 5 years, going back to your question, is that I think ETFs are going to basically play a much more important role going forward. And at a certain point, the flows into and out of ETFs will have the same kind of impact that we actually see in mutual funds today. One other observation is that we had a particularly poor performance last year. It's actually among the worst. But what you have to remember is that when the municipal market performs poorly in any given year, and you can go back 25, 30 years on this statistic, the next year performs well. So it's kind of a snapback. And the reason for that, I think, is that most private clients realize that at a certain point, they really have to participate in this market as a tax shelter. So even if they exit for a short period of time, they tend to come back. And we do expect they're going to come back in this round as well. One other observation is that the municipal high yield space has been a space where it kind of got hit pretty hard last year. But as investor expectations are coming around to the view that maybe the Fed is going to plateau in terms of how much tighter monetary policy it's going to employ, it's looking like there's a little more interest in the high yield space than there was just 6 months ago.